Welcome back, everyone, to Vox Markets. My name is Paul Hill, and on today's special Thanksgiving edition of Voice of Wall Street, I am delighted to be able to speak to Chris Watling of Longview Economics, one of the world's finest investment firms and research houses. So welcome, Chris.
Hi, Paul. Great to be here. Appreciate the opportunity.
Yeah, well, now given the the recent concerns over rising bond yields and inflation expectations, added on now to concerns over lockdowns in Europe, what's your outlook in 2022 for capital markets?
Well, I mean, the first thing is to think about what the economy is going to do, and I think it's teed up to be an enormous, strong growth surge, actually. So, yeah, a little bit worried, of course, about some of the resurgence of COVID, but in reality, it looks like our analysis suggests it's really people not getting vaccinated in those countries and a lack of boosters. You know, this whole story that after 5 or 6 months, the vaccinations wane a bit, and therefore you get a bit of a rise in infections and so on. So the boosters is key, as we've shown really in the UK. And if I look at the global economy, the pent-up demand is absolutely enormous. The amount of cash in bank accounts, people talk about it, the rise in house price wealth, the amount of fiscal stimulus that keeps on coming through. We just had another bill going through the States at the moment. It's really quite extraordinary. So, for us, the big theme for 2022, or at least for the first 3 quarters, is that the economy is going to be super strong, and it's going to be backed up by central banks that are really wholly on side. It's quite a powerful combination, I think, for financial markets.
And will the central banks actually respond to that strength, or are they just going to continue to run the economy hot?
I think we've got this what I call this global schism in central banking, which is a strange word that people normally use to talk about the split in the church several thousand years ago. But schism's a great word, I think, and of course it means split. And in this instance, I think we have a schism in central banking, whereby actually quite a lot of the second line, what I call second line or mid-tier central banks, have really started raising rates aggressively. We had the Poles and the Czechs a few weeks ago. We've had the New Zealand central bank. We've had the Norwegian, the Canadian making noises, and all sorts of things going on in those central banks. And then the big mothers, the big daddies the big daddies of the central banking world, the Fed and the ECB are really being, very slow to move and very cautious, and therefore providing tons more liquidity. So, I can't see the Fed doing anything, and really they're the one that matters the most. I can't see them doing anything significant until the middle of next year. In terms of interest rates, obviously they're tapering, but in terms of rate hikes, it's really getting pushed out to the middle of next year. So, and the other point worth making in that is what happens to inflation in the first half, because that's an important part of that mix. And our view is very much that inflation will recede temporarily, at least in the first half of the year, giving the Fed a little bit of breathing room and therefore allowing them to push back rate hikes all the way through into 2H next year.
Well, I was just looking actually at one of the 1 year forward inflation rate for the US, and it was about 4.5% on average. So if we just use that analogy of the big daddy, the giant haystacks of the US, the Jerome Powell, if he has a 4.5 print at the start of next year, or possibly even higher, because I think that the inflation's higher at the moment, he continues to lock his interest rates down to zero, or just about to zero. Where will the 10-year Treasury be, the yield on the 10-year Treasury at the end of 2022? Because it's currently 1.6. Where's it like to head?
Well, I think, giving a specific point forecast is always quite hard. But what I'd say on the 10-year,
I don't want to put you on the spot there, Chris, but I will.
Well, markets aren't that simple. So I think the way to think about it is I can see US 10-year yields being 2 spot and change by the first half of next year. I think that's quite likely, and maybe moving towards 2.5 into the third quarter. But I think at some stage, once the Fed starts moving in Q3, there's every reason that curve might start flattening, and you might start seeing bond yields move a bit lower. So I would think about it in chapters and waves rather than years. And the chapter we're in at the moment is a rising bond yield, and I think that chapter, it started in August 2020, really, when US 10-year yields were down about 50 bips. equivalent to where they were in sort of March, April 2020. And it's continued through this year with a pause. We've consolidated that move higher in yields. And I think we're starting to move higher again. So 2 and change, middle of next year, Q3, maybe 2.5 yield, that sort of number, I think, sensible.
And what areas would you say are sort of like, favourable in that environment of a sort of like steepening yield curve, low short-term interest rates, lots of monetary stimulus, and plenty of GDP growth? I can think of a few myself, to be perfectly honest. But what are the areas you sort of like you're putting your money into, or you're suggesting to clients to invest in?
Well, it's fascinating you say that. I mean, I always think that the market is one sort of big giant puzzle based on key macro factors. So, as you said and hinted at, once you get that kind of environment, strong growth, falling inflation, at least temporarily falling, and rising bond yields, there's a few places you really want to put money. I think one of them is financials. And of course, if you look at the banks over the last 6 months, most of them have really gone sideways or even given back into a bit of their gains. They had a very good run, as we know, from the back end of 2020 into Q1 2021. Then they sort of paused for 2 quarters, and I think they're ready to go again and stick with the classy names. I always think JP Morgan, Goldman Sachs, Bank of America, and of course in most of those you get both commercial banking exposure and investment banking exposure. And you want investment banking exposure at the moment because capital markets activity is on fire. There is so much money around. M&A's on fire, issuance is on fire. This is a great environment for these kind of stocks. So you get the commercial banking exposure and the investment banking exposure. It's a great place to put money. So that would be one key area I'd certainly put money.
And just on that one, I'd say I'd point investors, have a look at those, because I know when we spoke about 5 or 6 months ago, you were keen on the financials, and you did really. In fact, over 12 months, I think you've done really well out of it. But actually, even though the banks have done well over that period, they're still relatively cheap. I've got JP Morgan on less than 14 times, Bank of America on 14 times earnings for next year, Goldman's on less than 9, Citibank on sort of just over 8, and even Wells Fargo is only on 15. So it's significantly less than the market multiple, isn't it, I guess? So with a steepening yield curve, it looks value there.
Yeah, I mean, they're not too bad on PE ratios. Obviously, you want to look at them on book value as well, and they're not quite as cheap on that. But but the point is, I think they'll go with the momentum, and the yield curve is telling you that there's going to be more lending coming into the economy. They've got an awful lot of liquidity and money that they want to put to work, and their capital ratios are really strong. So they've got capital. They need to get money into the economy, lending into the economy, and investing in the economy, and that will improve their returns. So absolutely, I mean, if you want cheaper banks, of course, you can go to Europe. I think you'll do well there as well.
Deutsche Bank, for instance.
Well, even Deutsche Bank, but I'd actually prefer the UK banks because I know them a bit better, and there's less risk out there. With Deutsche Bank, you never know; you may get a bit of a sort of Credit Suisse moment, or a Deutsche Bank moment even. So, but yeah, you can go to the UK banks.
You were sort of hinting that this is going to be 3 quarters, 1 quarter. Would that sort of like go towards the whole of the end of the year, or if you get sort of like towards the back end of next year and you do get giant haystacks, Jerome Powell increasing interest rates in the States, and there's a whiff of sort of that's increasing or accelerating, and likewise if inflation does return towards the back end of next year, will the banks, is there a time issue on this one, or is it basically play it for the first 6 months and then reassess?
Well, yeah, what you need to do is you need to think about how much is, to extend your analogy, how much is giant haystacks really getting into the ring? I mean, that's the key, I mean, and of course, that is all about how tight does the labor market seem? Because if you think about inflation, I've always said that this, you'll be aware, we're all aware, there are lots of theories about what drives inflation. And you can be a monetarist and disagree with a Phillips curve guys, or you can take all sorts of approaches to inflation and argue until you're blue in the face. But I think the reality is we've had monetary inflation over the last 6-9 months. And what the Fed's not interested in that. That's not its theory. It dismisses it. We saw Janet Yellen, for example, I know she's Treasury Secretary now, but the other weekend talking about the fact that it's just to do with disruptions caused by the pandemic. So they dismiss that. And what they're really looking for is a tightening of the labour market, the Phillips curve idea. So that's why I say, keep your eye on the data as we go through the year, because you can make arguments both ways on the labour market. You could argue it's already pretty tight, or you could argue actually there's quite a bit of spare capacity that could take us way into 2023. And really, the reality is, the honest truth is, we don't know what the pandemic's done to the way the labour market operates. No one knows. And there is no one out there that can tell you that. So it's up in the air. You've got to watch it. And that's all the Fed will be doing. And therefore, you'll have time to react, is my view. So I think that's the way to play it. If the Fed speeds things up, it'll be 2 or 3 quarters of banks doing well. If the Fed is very slow, then you may get the whole year in terms of that trade. And that's the way I think about it.
And I was looking at the sort of the portfolio, or sort of the hypothetical portfolio, of Longview, and you've obviously done really well. How easy is it to sort of like squeeze that last bit of alpha out the market in relation to timing? What are you going to be looking at next year to get that right, to make sure that the bank trade still works to the back end, or if you've got to jump ship and take profits early?
Well, there's a bunch of things I would look at, and I combine technical factors. So sort of classic technical analysis. Does a sector look overstretched in price terms? Is it overbought? Has it moved too far? We would think about valuation a little bit, but it's not our main driver. But maybe on a relative basis, that would certainly be interesting. And then what we do is we start thinking about what might move the bond market. So if you get the bond market turn right, you're going to get banks broadly right most of the time. And often what you'll find is, as it looks like the bonds are starting to be pretty oversold, in other words, the yield's pretty high, the banks are in the same. Their banks are overbought, and you can add it all up, and it becomes quite a powerful mix when you add the macro and the technicals and some positioning and some sentiment indicators. And I think once a trade becomes crowded and the macro looks like it's turning and the sector's overbought, then I'm pretty nervous. So we watch all of that all the time for all sorts of asset prices. That's kind of some of the key stuff, and take a lot of trading views on that. Now, if you're investing over the cycle, that's a different ballgame. But we're talking about 6 to 9 month moves. I'd say it's trading / investing, or it's sector rotation in this instance, if you like.
And I know you like quite a sort of like a barbell strategy here, because you like the banks, obviously, and then on the other end of it, you quite like some Megatech, don't you? Do you want to take us through that thesis? Because I would have thought in a sort of like a rising yield type of environment, which happened at the start of 2021, you had the FANG stocks, and a lot of NASDAQ got taken to the woodshed.
Yeah, you have. And to be honest, it's a sort of slight hedge, but it's also, as well as a hedge, it's also a hedge, or it's not a sort of classic hedge about being wrong on bond yields. I think more importantly, it's a hedge about perhaps we're in one of these bubbly, squeezy markets. It certainly feels like it. And you'll remember well, 1999, late 1998 into early 2000, the market advance was very aggressive in the US, but it was very narrow, and it was concentrated on very few handful of TMT stocks and the big cap tech stocks. So, and that was in a rising bond yield environment. So what I'm trying to do is just ensure there's a bit of offset there, a bit of hedging, and something that may work well in both sectors. So mega cap tech could actually, for once, work well with financials and other sort of classic rising bond yield plays. It's not impossible. And as the market narrows, it'll focus in on those big cap tech. So what we're not doing is we're definitely not suggesting second line tech stocks. I wouldn't personally buy Tesla. I think it's far too risky. But the big fangs, the very big fangs, like to Microsoft, which is, it's a cash cow. It's really, in some ways, it's defensive. And Google as well. These are cash cow stocks. They're very impressive stocks.
Yeah, I mean, I think they trade on around about 30, just over 30 times next year's sort of PE. But you're right, they generate so much cash, and their balance sheets are just pristine, aren't they?
Quite extraordinary.
What about something like Apple? Is that sort of like too much hardware for your liking? I mean, that's That's obviously the $2.6 trillion business now.
I've never really liked Apple. I think it's because I have a Samsung, so I'm probably
okay.
I have this natural
no
bias.
prejudice there at all.
It's like me asking me to buy Arsenal when I'm a Chelsea fan. It just doesn't work. I mean, but I mean, Apple's obviously been extremely good performer, but it's less of. I'm not a big expert on Apple, but I don't see it as such a good growth stock. It's sort of it is a granddaddy of the big cap tech, and it just doesn't feel right to me. I'd rather stick with Microsoft and Google, which are very solid cash flow growth earners, I think.
Yeah, and you talked about sort of like Tesla, but let's just broaden that out to the whole EV space. We've had Rivian sort of like IPOing, which went really well, and I think up until today, and then Ford had decided to do a U-turn on that strategic EV partnership. But you've also got, I know you've mentioned it before as one of your bellwethers was NIO, and so you've got so much money and interest being piled into the EV space, and Tesla is now worth more than $1 trillion, amazingly enough. What's your sort of view on that? Is that signaling alarm bells on your sort of like fund flows, or how are you viewing it, the whole EV space?
Yeah, I mean, I think it's a classic sign of a bubble. I mean, I think I'm a big fan of the Grantham thesis that we're in a stock market bubble, and of course, one of the signs is easy money inflates certain asset prices very aggressively. Tesla and Nvidia, of course, both up 50% in terms of their market cap in October. It does remind you of what they did in August last year. And the amazing thing is they're not small stocks. These are mega cap stocks.
Yeah.
And of course, Tesla's, I believe it's in every ESG portfolio. It's become trendy, and there's a stock to own because it fits certain criteria. I would look at things like that. I'd lump them in with crypto. It's a sign of too much easy money, in my opinion. I mean,
what's your view on sort of crypto? Because obviously it's another sort of like adjunct to the Elon Musk brigade almost, because he talks about Bitcoin all the time and Dogecoin, I think, and all that kind of stuff. But I think I saw a stat that if you added all the crypto together, it was now a 3 trillion or over a 3 trillion market cap. And I know I saw an interview from John Paulson, who described crypto as a sort of a limited supply of nothing, I think he said. So how do you sort of like, pitch it as an investment vehicle?
Well, I love the way you say limited supply. I think it's actually become almost unlimited. I mean, I loved the original idea of Bitcoin, which is in 2009, one digital currency to control the sort of money creation of central banks. Fantastic. Governments got carried away. Great. Let's limit the supply. But now there are, as you know, between 4,000 and 8,000 cryptocurrencies, depending on who you ask. And a classic sign of a bubble is a massive expansion of supply. So there may only be 21 million Bitcoins out there, but there's 8,000 cryptos, and any Tom, Dick and Harry can create one, it seems to me, and say it's the next big thing. I think it's, you're quite right. It like Tesla going up by 50% in market cap in October, cryptos pretty much did the same, added 50%. So I just see it as another sign of the madness, really. I love the original idea of Bitcoin, but as Henry Kissinger said, he who controls the money controls the world. And the reality is that, the US government is not going to allow crypto to be the dominant money in the world. It will be the dollars. They exercise geopolitical power through the dollar hegemony. The financial system denominated in dollars allows them to implement sanctions upon countries they find they're not comfortable with. So the idea they're going to give that up and allow Bitcoin and other cryptos to take over, I just don't see it as plausible, quite frankly.
And if you dare to say that bubble pricks or bursts in 2022 in terms of EV or valuations come off, and likewise with crypto, how would that sort of like play through your thesis of a sort of like a strong economy? Because obviously that would lead to a lot of perceived sort of like wealth destruction. It'd certainly take a lot of juice out of the stock market and somebody's own sort of spending capacity.
Yeah, I think it plays in terms of the market terms, plays into that idea of the narrowing of the advance into the big cap tech. So people stop making money in the second and third line tech stocks, as they have in some of the stay at home plays like Peloton and things like this, which are, I think, below issue price now. And it speaks to a narrowing of the advance and a concentration in the large cap tech. But I have to say, I mean, if it bursts enough and viciously enough, you may well. I mean, I remember very well in 1999, we used to correlate the NASDAQ monthly move with retail sales. And what the NASDAQ did generally told you what retail sales was going to do in the last few months because there was such a dominant wealth effect. So, that may well come back. So at some stage, again, that's got to be watched closely. I think that's a really important part of the equation.
Yeah, and is there anything else you sort of like want to go long? I know you talked briefly about sort of cyclicals or something like that, which is going to take us through that thesis.
Yeah, I mean, I like industrials in general, and I'm not as good on particular names in industrials as I should be, but there's a long list in that one can look up the S&P 500 industrials. I know some of my colleagues like Johnson Controls is a big pick, but I mean, the reality is, industrials were very expensive in March, April this year. They're on a relative valuation, they had a big market premium, one of their biggest premiums in the last 20 years. And in the last 6 months, they've tracked sideways, given back some of those gains. And they now look reasonably priced. So they're in line. It's a sector that tends to do well when bond yields are backing up and growth is strong, of course. There's a whole inventory rebuild story globally that's still to come through. If you look at finished goods inventories in all sorts of sectors, they're on the floor. Autos we all know about, but the same comments in retail, same comments across the Eurozone. And of course, the industrials will do well from that industrial cycle, rebuild of inventories. They're at the beginning of the supply chain, if you like, sort of after the commodities. They're making the stuff. So, I think the consumer's strong. They'll be consuming a lot of goods, and these guys will be making them. And housing will do well as well. A lot of them feed into that. There's a defense sector, CapEx story they feed into. So I think it's a good sector. It's a good place to be. Yeah.
Yeah, it's quite interesting that, because you'd have thought sort of counter. I thought intuitively that if you have everybody locked down for 2 years, which is the case has been, and everybody's been buying sort of fridge freezers, TVs, PCs, and everything sort of associated with goods. We're moving now to more of a service type of orientation for overseas holidays, going out for meals, partying, nightclubs, all that kind of stuff, experiences. And therefore, you'd have thought there'd be less demand on goods and stuff, that it's been brought forward. There's only so many of the sort of the durable goods you could actually buy. But actually, what you're saying is that because there's so much money, that's still going to continue, aren't you?
Well, exactly. There's that. And also, the different types of goods as well. I mean, I think the residential story continues in terms of home buying and strong house prices. Yeah. And that feeds a lot of it. The defense story continues. There's clearly an escalation of a mini arms race between China and the rest of the world. So that one's not going away. And also there'll be a lot of capex because there's a shortage of capacity in a lot of sectors. So all of that is good for these sort of stocks, absolutely.
Yeah.
But yeah, for sure, there probably won't be as many laptops bought. There may not be as many sort of garden spades. I don't know, but there'll be a bit of a switch. But there's still plenty of goods to be bought, and we created a lot of new money, so that's still there. It's in bank accounts. They're going to spend it on a lot of services, but also plenty of goods.
Yeah. Okay, then. So. Moving swiftly on to other things we might shovel through this time. And what about areas that you would be short? Let's start big picture, bonds. How are bonds going to be if you have a sort of like what you're saying is if you've got a sort of slightly falling inflation rate at the start of the year, but rising sort of treasuries, and then you've got sort of like a higher inflation rate coming through the front and the rising interest rates. What's your view on bonds?
Yeah, be short bonds. So obviously looking for the yield to move up towards 2 and change. And really, it's the interesting part is the mix within that. So of course, a lot of if you we like to split bonds into implied inflation and real bond yields, and that is broadly speaking the nominal yield. There's a couple of technical inflation risk premium things on top of that, but ignoring that for the moment, implied inflation and real bond yields, all the heavy lifting's been implied inflation going up, and real bond yields in the States, for example, are on the floor. They're as low as they've ever been. They've bounced along the bottom since August last year. Now, I think if growth really starts to accelerate and inflation come off, then implied inflation comes off, but real bond yields back up quite hard. So we get them moving from -1 and change back towards zero, maybe above zero. So it's a different mix of movement, but I'd be short bonds in aggregate, but expecting the TIPS yields to do a lot of that rising yield work, if you like. And of course, a rising yield is a falling price in bonds, and that's the key there. So yeah, short bonds. And with that, I'd be short gold. That's the sort of next sort of follow on. That people talk about gold being an inflation hedge. Well, that's
safe haven usually.
Yeah, well, safe haven, yes and no. I mean, the reality is, over 500 years, it still buys you the 1 ounce of gold buys you the same amount of suit that it bought you 500 years ago. If you want to go and buy a new suit or whatever, fine, great. So it is an inflation hedge in that sense. It is a store of value. But how it trades? It trades in line with real bond yields. That's what you look at. You look at real bond yields flipped upside down. So, and that is actually an implication about money liquidity, which is really another implication about long-term inflation deflation trends. That's the sort of link, if you like, the sort of theoretical link. So, if real bond yields are backing up towards zero from -1 and change, then gold's going to come under pressure. That would be my point. And I want to be short gold in that environment.
Any names or I don't know, classics of Barrick Gold and people like that?
Yeah, I mean, Barrick Gold's a great example. The bigger market cap they are, the more likely they are to trade in line with the gold price. And Barrick Gold correlates very well with the gold price. So you could do that. You can do a gold ETF, gold sector ETF. I forget the symbol. Yeah, sure. But all this stuff trades in line with the gold price. Gotcha.
And then just coming back on the actual bonds, I mean, what you saw over the last year, what was quite interesting, was relating to junk yields, etc. If you split it into investment grade and junk yields, you had your junk yields, which were trading at sort of like, pennies in the pound, particularly in the oil and gas space, for instance. But because of actually the oil and gas price increasing, and now it's sort of like just south of $80 a dollar, and gas price is doing really well, the credit quality in the junk state, particularly in the energy, has improved massively, and a lot of these have actually gone up their notches in terms of in terms of the agency ratings, and they've done really well. And that seems to be a thesis that still going to sort of like bode well going forward, because if you're saying there's going to be a strong economy and there's going to be companies generally doing well, particularly I don't know, who have got quite a bit of debt, maybe in industrials or whatever like that. If you got improving credit quality in those areas, the junk yield should do okay, but also the banks should do okay, as you rightly point out, because that'll improve their credit quality and exposure. So you want to just talk through that, how you see that one playing?
Yeah, I mean, that's absolutely. I mean, but I suppose a lot of that's in the price. I mean, depending on who you're looking at, but certainly in terms of the oil stocks, you remember we had oil at -$20, $30 or whatever.
Yeah, that was the 23rd of April, 2020. I remember turning on my smartphone. I couldn't believe it.
Well, we actually wrote a piece before that. Could oil go negative?
Well, you're spot on. You were dead right.
Well, I think we're almost a little bit tongue-in-cheek. I mean, I thought oil was under pressure. I certainly didn't think it would go to -20 or 30. But it was very interesting because it tells you it's a classic problem, isn't it? It's a classic short squeeze the wrong way round, if you like. And commodities do that. And we've had it the other way around with commodities in the last few months, with the spot price spiking much higher. So, but yeah, I think if I look at the oil, I mean, those oil stocks, some of them are brilliant free cash flow generators. They throw off a ton of cash, absolutely. But really, they tend to trade in line with the oil price. So if our analysis suggests to us the oil's had extremely good run, as you just articulated, from -20, 30 to 80 odd now, and it's starting to give back some of those gains. And I think what you see is the changing fundamentals. OPEC's opened its supply taps, as we know. They did a deal in July, and they're adding 0.4 million barrels per day to the market, per month to the market, per day per month, if you like. And shale, we think, will come back next year. And once you add it all up, with a pickup in demand, lots of supply from OPEC, more supply from shale, you end up with a supply surplus in oil, so a bit of a supply glut. So, I think that's the sort of thing that gets the oil price back to 60. Maybe it's 65, and that's the sort of reason that the oil stocks won't do so well. So, like we said at the start, if inflation softens in 1H, energy, I think, will come off as well. Oil will come off, and maybe you want to buy these stocks in Q3 in the middle of the year if inflation starts picking up again. But I think for now they've had an extremely good run. You can't work out the percentages from a positive move from a minus negative one, but it's a very big, it's $100 move in a sense, isn't it? It's really quite extraordinary.
And you'd be short sort of your big integrators, sort of like your Exxon, your Chevron, Shell, BP, that sort of stuff would be the classic plays.
Again, yeah, exactly. You can pick the big cap stocks. Most of them tend to move in line with the oil price.
Or the higher beta ones, the sort of the E&P stuff upstream, something like that. But just coming back, so why do you think the shale boys, the US shale boys, will increase capacity? Why won't that come back on stream? Because there does seem at the moment seems to be a reasonable level of discipline, capital discipline. If you look at the rig counts, it hasn't come ballooning through yet in the US.
No, it hasn't come ballooning through yet, but there's certainly a lot of talk about lenders wanting to lend money to these companies. A number of these companies are talking about increasing capex. And if you look at the sort of spread between the oil price and the break-even shale price, it's very, very wide. A bit like we had before they had a last surge in I think, I try to remember which year it was, 2017. Into 18, I think they if I'm getting my timings right, but so we had the 14 fall off, then we had a flat year for a couple of markets, and then we had that widespread again, I think 17, 18, and they started getting stuck in again. So I think they'll do that. It's pretty logical. The signs are there, the money's there if they need it. Banks are starting to open the spigots. I know this is all this chat that you can't get financing, but actually, I think there's plenty of banks that still want to. I mean, banks are awash with money. They want to lend it to people, particularly the ones in the southern states, where the oil is primarily.
Yeah, particularly if they can get a better pickup in the yield when they can lend it out at a higher rate. Yeah, no, I'm with you. And then just lastly, then I'd be remiss without actually asking you about the meme stocks. How do you see those played out? I mean, I still cannot believe you've got the likes of AMC Entertainment, which is non-profit making and is worth $21 billion. And then you've got GameStop, which is on $17 billion, which again is on a P ratio of 163. That's 2024 estimates. So they're crazy numbers, but they still do well. I mean, again, I suppose it's just sort of talk through how that you see that meme stock going.
Well, I think it's sort of thing we'll look back on in a few years' time and say that that really was complete insanity. I think I did write about the AMC stock a few months ago, and I'm trying to remember. I think the market cap at the end of last year was 200 million or something like that, or 150 million, something along those lines. Yeah, and it's now 20 odd billion or
just over like 21 billion. It is
21 billion. I had a look at that. I remember a few months ago, I had a look at their business model. Could it be a case of the George Soros idea of reflexivity? The stock changes, it gets more value, it raises money, it changes its business model. Suddenly it's worth what it seems to be worth. The market's seen ahead of us. But I couldn't see that for AMC Entertainment. I mean, they're a cinema stock, and I don't think they've changed their spots. I would advise people to check beforehand. But to me, it looks more like a sign of the easy, crazy money. And what's fascinating about the share prices, if you look at them, they've got this wonderful technical pennant formation that's formed over the course of this year. And of course, all technical analysts will tell you, when you've got a pennant, you're going to get a breakout. And my bet is that as we get into next year, that liquidity eventually starts to tighten. The margin of liquidity we've started with tapering, or we're about to start, if you like. So eventually that, whoever's the most extreme gets bitten first. And that's what I'd expect with these meme stocks. It's to me, it's a sign of too much money in the world.
And would you ever go short these things and the crypto? I mean, and if you would, how would you do it safely? Because there's lots of very clever people at the start of the year who thought they were short. I think there was Citron Research, for instance. Andrew Left got again taken to the woodshed. I think he was a very bright guy, being short the wrong side. And so if you were going to short these, how best would you play it? Presumably, through the options market or something like that?
Well, it's a good question. No one wants to be taken to the woodshed. I don't know what happens there, but it doesn't sound good. But well, I mean, I think you've just got to, firstly, you want to do it when everyone's stopped talking about them, which I think they have. You want to do it when no one's really short. I don't know that. I don't know what the short interest is like at the moment. And then you want to do it when you see signs of tightening money. So, and you may want to wait for some sort of technical signal, some sign of momentum rolling over. It's the sort of thing that once it looks like it's gone, it could go very quickly and very fast and go quite a long way. So I don't commit a lot of money to it. Maybe do it with options. That's probably a good idea. And I think look for those sort of signs. It's really about the tightness of money. It's not. There's clearly not about fundamentals. We know the fundamentals. This is why these guys write these pieces, because the fundamentals are crazy. There's no way the share price is justified by the fundamentals. So on a fundamental view, it's clearly a short. And then the question is, what's your timing? And the timing is about liquidity. So that's the way to think about these things, I think. But when it's the moment. I think generally in these instances, it's hard to predict when the moment will come. But you often see it in the way the share price starts trading.
Yeah, and I guess it probably means that you need an expert like Longview Economics to help you with that sort of timing, because I've got frankly no idea how to play that one. So I'm going to be looking to you. I'm going to be looking to you, Chris, for you to tell me. Okay.
Very good point.
And then just finally, are we going to get a Santa rally at this year? We've got sort of like a few weeks left. We normally get one heading into December. What's your view?
Well, Santa's a great bloke and he almost always turns up. That's what I always think. But people think Santa turns up in October and November. He doesn't turn up until middle of December. And if you look at the seasonal patterns in the S&P, it tends to peak on the 3rd of December and sell off to the middle of the month. And then it just sort of, he gets in his sleigh and it trots all the way up through to year end. So I think we're going to get it. I think, to be honest, the S&P's traded fantastically in the last 2 weeks. You remember October into November, massive rally in the market. I think the S&P was up over 10% from lows to the 5th of November highs. And it's gone sideways since then. Very impressive price action to sort of hold on to your highs as you consolidate your gains. So I think the market's telling you it's going to have a Santa rally. It looks good to me, and it's got a lot going for it. So Christmas is coming.
No, we like the gifting season, that's for sure. So thanks very much, Chris, for your views. And if any investor wants to sort of like learn a bit more about the services for Longview, how is it best to sort of like, is it just contact you directly or contact your company, or how's the best to sort of learn a bit more about what the company offers?
Well, the best way to start is really jump on the website, longvieweconomics.com. We have services for private investors and for institutional investors. We have some packages up there for private investors, whether they want to be a trader or a longer term investor. We have different types of products depending on your time frame. And you can engage with that on the website electronically, or if you want a sort of bells and whistles service, an institutional service, then you just click on the fill in the form and it'll come through to us. We'd love to help.
And I would point investors, have a look on that website, because there's the returns have been frankly incredible. So really, really strong. So well done for you and the rest of your team, Chris, because my portfolio over 2 years hasn't done too badly, but it did suffer a great deal last year. So I could have done with some of your guidance, that's for sure.
Well, you're very kind.
Flows. But
very kind. Well, God willing, it will continue. We shall find out.
Yeah. But anyway, best of luck, and thanks very much, and have a good Christmas, Chris.
Thanks for your time, and you, Paul. Thanks very much.